40.38. That is the number that is about to destroy your retirement account. And here is what makes it terrifying. In 155 years of recorded stock market history, this number has only been higher once. One time, December 1999. And if you remember what happened next, you know where this is going. The dot-com bubble exploded. The NASDAQ crashed 78%. $6 trillion evaporated. It took 7 years just to break even. And right now, in February 2026, we are back. The number is 40.38. And every single person at the Federal Reserve knows what it means. The question is not if the market will crash. The question is when and how bad. Let me show you why 39% is not a prediction. It is math. September 2025, Federal Reserve Chair. Jerome Powell stood in front of cameras and said something Fed chairs almost never say. Quote, "By many measures, equity prices are fairly highly valued." End quote. That might sound bland, boring, typical Fed speak, but to anyone who understands central bank language, that was a 5-alarm fire. Because the Fed does not comment on stock prices, ever. They stay neutral. They talk about employment, inflation, interest rates. But Powell looked directly into the camera and said, stock prices are too high. That is like your doctor saying, well, your symptoms are concerning. What he really means is, you need to get to the emergency room, now. But it gets worse. December 19th, 2025, the Federal Reserve holds its final meeting of the year. They cut interest rates by 25 basis points. Standard move. Nothing shocking. Except for one thing, 3 members of the Federal Open Market Committee voted against the decision. 3 dissenters. That does not sound like a big deal until you understand this. The last time 3 FOMC members dissented was 1988, 37 years ago. Most people watching this video were not even born yet. And here's the kicker. The 3 dissenters did not even agree with each other. Some wanted to hold rates higher. Some wanted to cut more aggressively. They were arguing in opposite directions. You know what that means? The people with access to every piece of economic data in the country, the smartest economists in the world, cannot agree on what is happening. And if they cannot figure it out, what chance do you have? Let me explain the number. 40.38. This is called the Shiller Price-to-Earnings ratio, also known as CAPE, cyclically adjusted price to earnings. It was created by Robert Shiller, a Nobel Prize-winning economist at Yale. And it is the single most accurate predictor of stock market crashes in history. Here is how it works. You take the current price of the S&P 500. You divide it by the average inflation-adjusted earnings of the past 10 years. This smooths out short-term noise. It tells you what the market is really worth compared to what companies actually earn over the long term. The historical average, going back to January 1871, is 17.33. Right now, on February 6th, 2026, the Shiller PE ratio is 40.38. Let me put that in perspective. 40.38 is 135% higher than the historical average, 135%. That means if this market were a house, you would be paying $2.35 million for a house that historically sold for $1 million. And you would be doing it with a mortgage you cannot afford, at interest rates that are rising, while the foundation is cracking and the neighborhood is on fire. But here is where it gets absolutely terrifying. In 155 years of data, there have only been 6 times when the Shiller PE ratio stayed above 30 for at least 2 months during a bull market. 6 times. Let me tell you what happened every single time. 1929, Shiller PE hit 32.5. The stock market crashed 89%. The Great Depression followed. It took 25 years for the market to recover, 1965 to 1968. Shiller PE hit 24 to 30 range. The market went sideways for over a decade. Stagflation, lost decade, 1999 to 2000. Shiller PE hit an all-time high of 44.19. The dot-com bubble exploded. The S&P 500 fell 49%. The NASDAQ fell 78%. $6 trillion erased. 2007. Shiller PE hit 27. The financial crisis hit. The S&P 500 fell 57%. 8.8 million Americans lost their jobs. 22 trillion in household wealth destroyed. 2021. Shiller PE hit 38.5. 2022 crash followed. The market fell 25%. And now, 2025 to 2026, Shiller PE is at 40.38, second highest in 155 years, only beaten by the dot-com peak. And you know what happened next. The track record is perfect. 6 out of 6. 100% success rate. Every single time the Shiller PE ratio goes above 30 and stays there, a major crash follows. The drops range from 20% to 89%, but they always come. Always. 155 years of data. Never been wrong. Not once. And right now we are at 40.38. That is a 135% premium to the historical average. Let me make this crystal clear. If you are invested in the stock market right now, you are paying 135% more for every dollar of earnings than investors have paid on average over the past 155 years. You are at the second most expensive moment in stock market history. And history says you are about to get crushed. So where does the 39% come from? Let me show you the math. When the Shiller P/E ratio exceeds 30 during a bull market, it has never bottomed out during the subsequent crash at a level higher than 27. Never. Not once in 155 years. So if we are at 40.38 now and the historical floor is 27, what does that mean for stock prices? Simple math. 40.38 divided by 27 equals 1.496. That is a 49.6% premium. Subtract 1, you get the required drop. 49.6%. Wait, you said 39%? Why the discrepancy? Because I am being conservative. The Shiller P/E ratio does not always go all the way down to 27. Sometimes it stops at 30, sometimes at 32. So let me give you the minimum drop scenario. If the Shiller P/E only falls to 27, the market has to drop 33%. Minimum. That is the best case. If it falls further to 20 or 15 like it did in 2008, the drop could be 40 to 50% or more. Let me translate that into S&P 500 levels. Right now, the S&P is trading around 6,900. A 33% drop takes you to 4,600. A 40% drop takes you to 4,100. If we get a full-blown crash like 2008 and the Shiller P/E falls to 15, we are looking at 3,500. That is a 50% wipeout. Your $500,000 retirement account becomes $250,000. Your $1 million portfolio becomes $500,000. Half your wealth. Gone. Before you say, that is never going to happen, remember, it already has. 2008, 57% drop. 2000 to 2002, 49% drop. 1929 to 1932, 89% drop. It has happened before. It will happen again. The only question is when. But the Shiller P/E ratio is not the only problem. There is something else, something that makes this crash different, and potentially worse. Market concentration. Right now, 7 companies control over 1/3 of the entire S&P 500. 7 out of 500. Apple, Microsoft, Alphabet, which is Google, Amazon, Nvidia, Meta, which is Facebook, and Tesla, the Magnificent Seven. Together, they make up between 31 and 37% of the S&P 500's total market value. 37%. Do you know the last time the market was this concentrated in just a handful of stocks? 2000, the dot-com bubble. The top 7 stocks back then were about 35% of the market. And we all know what happened. They crashed. And they took everyone else with them. But here's what makes it worse. Back in 2000, if you owned an S&P 500 index fund, you were diversified, 500 companies. Different sectors, different industries. If one went down, the others cushioned the blow. But now, 37% of your index fund is just 7 companies. If those 7 fall, your entire portfolio falls. You're not diversified, you just think you are. Vanguard and Fidelity have actually updated their fund prospectuses to warn investors that their S&P 500 funds may become, quote, technically non-diversified under the law. Let that sink in. The most popular index fund in America, the one that is supposed to be the safest, most diversified investment you can own, is now a concentrated bet on 7 tech stocks. And if those 7 stocks crash, you crash with them. But wait, it gets worse. Because 2026 is not just any year. It is a midterm election year. And midterm election years have a very specific pattern. Since 1957, there have been 17 midterm elections. 12 of them resulted in stock market corrections of 10% or more. That is a 70.6% probability, 7 out of 10 chance. And the average intra-year drawdown, meaning the biggest drop at any point during the year, is 18%. 18%. Even in years that ended flat or positive, the market dropped 18% at some point. Why? Because midterm elections create uncertainty. Which party controls Congress? Will the president's agenda pass or stall? Will there be gridlock? Will there be a government shutdown? Investors hate uncertainty, and they sell. Every single time. But 2026 is worse than a normal midterm. Because we have Trump, and Trump is unpredictable, his tariffs have already pushed import taxes to the highest level since the 1930s, the Great Depression era. And those tariffs are causing chaos. Some companies are passing the costs to consumers. Prices are rising. Inflation is sticky. The Fed cannot cut rates aggressively because inflation is still above target. But if the Fed does not cut rates, the economy slows. Unemployment rises. And if unemployment rises during a midterm election year, voters get angry. They vote out incumbents. They demand change. And that creates even more uncertainty. And more uncertainty means more selling. So you have the Shiller P/E ratio at 40.38. You have the Magnificent Seven spending $500 billion on AI with no clear return. And you have a midterm election in a year where tariffs are at Great Depression levels and the Fed is trapped between inflation and recession. This is not one risk. This is three risks, all happening at the same time. And any one of them could trigger a 30% crash. All three together, we are looking at 40 to 50%, maybe more. Now, you might be thinking, okay, this sounds bad, but we survived 2008. We will survive this too. The government will step in. The Fed will cut rates. They will print money. They will bail everyone out, and we will be fine. Right? Wrong. Dead wrong. And here's why. In 2008, the Federal Reserve had 525 basis points of room to cut interest rates. They were at 5.25%. They cut all the way to zero, 525 basis points. Massive stimulus. They also had a brand new tool, quantitative easing, QE, printing money, buying bonds, injecting liquidity into the system. It had never been tried before. It was fresh, powerful, effective. The Fed's balance sheet went from $1 trillion to $4.5 trillion. They printed $3.5 trillion out of thin air. And it worked. The crisis ended. The economy recovered. The stock market came back. Crisis over in 18 months. But in 2026, the Fed does not have those tools. Interest rates are at 3.75%. If they cut all the way to zero, that is only 375 basis points, less than in 2008. But they cannot even go to zero. Why? Because inflation is still above target. CPI is 2.7%, core PCE is 2.8%, the Fed's target is 2%. If they cut rates too much, too fast, inflation spikes again. And they just spent 3 years fighting inflation. They raised rates faster than any time in history. They cannot admit they were wrong and cut them all back. They would lose all credibility, so they are trapped. Cut rates and risk inflation, or keep rates high and let the economy collapse. There is no good option, just bad and worse. And quantitative easing? The Fed's balance sheet is still over $7 trillion. They have already done QE1, QE2, QE3, COVID, QE. It is exhausted. The effectiveness is diminishing. Every additional dollar they print does less and less. It is like a drug addict building tolerance. The first hit works great. The second hit works okay. The 10th hit barely works at all. The Fed is on hit number 4, and it is not working anymore. And here is the other problem. The government is $38.3 trillion in debt. They are paying over $1 trillion per year just in interest, more than they spend on defense. More than Medicare, just interest. If they try to pass another $700 billion bailout like TARP in 2008, the bond market will revolt. Yields will spike. The debt will become even more expensive. They cannot afford it. Congress will not pass it. The political will is not there. Because Americans remember 2008, they remember the bankers getting bailed out while homeowners lost their houses. They're still angry. There will be no bailout this time. You are on your own. Let me give you 3 scenarios, 3 possible futures. And I want you to decide which one seems most likely. Scenario 1, soft landing, probability 30%. The Fed cuts rates 2 to 3 times, 50 to 75 basis points total. AI spending continues. Some return on investment starts to materialize. Companies show modest profit growth from AI. The midterm elections cause a normal 10 to 15% pullback, but nothing catastrophic. No major geopolitical shocks. China stabilizes. The commercial real estate crisis gets contained. Banks extend and pretend. Kick the can down the road. The market corrects to 5,900 or 6,200, down 10 to 15%. It takes 3 to 6 months, then it recovers. By the first quarter of 2027, we are making new highs. Crisis averted. This is the optimistic scenario, and it is possible. But given everything I have just shown you, it is not probable. 30% chance. Scenario 2, hard landing. Probability 50%. This is the base case, the most likely outcome. The market drops 25 to 35%. The S&P 500 goes from 6,900 to 4,500, or 5,200. Here's how it plays out. Second quarter, earnings disappoint. The market drops 10%. Third quarter, midterm uncertainty and recession fears. Another 15% drop. Fourth quarter, recession confirmed. Another 5 to 10% drop. Total, 30 to 35% from peak. The VIX hits 60. Unemployment hits 6 to 7%. The Magnificent Seven lose 40%. Nvidia down 50. Tesla down 60. The Fed cuts rates aggressively, but inflation constrains them. They cannot go to zero. They restart QE, but it barely helps. The government passes limited stimulus. Not enough. The recession lasts 12 to 18 months. The market takes 2 to 3 years to recover. You lose $150,000 on a $500,000 portfolio. If you're near retirement, you delay by 5 years. If you are young, you recover eventually. But it is painful, really painful. This is scenario 2, 50% probability, most likely outcome. Scenario 3, market crash, full AI bubble burst, probability 20%. This is the nightmare scenario. Everything goes wrong at once. A major AI company admits that their spending is not producing returns. Maybe OpenAI goes bankrupt. Maybe NVIDIA's earnings collapse. Maybe the whole AI hype cycle is exposed as a fraud. At the same time, a geopolitical crisis hits. China invades Taiwan. Russia uses a tactical nuke in Ukraine. Iran and Israel go to war. Oil spikes to $150 per barrel. Commodities crash. A major regional bank fails due to commercial real estate exposure. The credit markets freeze. Nobody can borrow. Companies start defaulting. High-yield bonds crash. The Fed cuts rates to zero. They do unlimited QE, but it does not work. The market crashes 40 to 50%. The S&P 500 goes from 6,900 to 3,500 or 4,000. 49 to 50% wipeout. The Nasdaq falls 60 to 70%. The Magnificent Seven are down 60 to 80%. Your $500,000 retirement account becomes $250,000 or less. Unemployment hits 10%. Foreclosures spike. A depression. It takes 5 to 7 years to recover. This is the 2008 scenario, or worse, the 1929 scenario. 20% probability, lower than scenario 2, but not impossible. History says it can happen, and the current setup says it might. Which scenario happens? I think scenario 2, 50% probability, hard landing, 30% drop, 2 to 3 year recovery. But I could be wrong. Maybe we get scenario 1, soft landing, or maybe we get scenario 3, crash. The point is, all 3 scenarios involve pain. Even the best case is a 15% drop. The base case is 30%. The worst case is 50%. There is no scenario where everything is fine and the market keeps going up. The Shiller PE ratio does not allow it. The math does not allow it. History does not allow it. The question is not if, it is when. And how bad? So what do you do? How do you prepare? Let me give you 5 warning signs, 5 indicators to watch. If you see 3 of these flash red, be cautious. Reduce your stock exposure. If you see all 5 flash red at the same time, get out immediately. The crash is here. Warning sign 1, the VIX, the fear index. Right now, it is at 18.64. That is elevated but not panic. If it hits 25, caution. People are getting nervous. If it hits 35, fear. Panic is spreading. If it hits 50, crisis. Everyone is selling. If it hits 70 or 80 like it did in 2008 and March 2020, full meltdown. Systemic collapse. Watch the VIX every single day. Warning sign 2, the Magnificent Seven. If any one of the 7 falls 20% from its recent high, that is an early warning. If 3 of them fall 20%, correction is starting. If all 7 fall 20%, crash is incoming. These 7 stocks are 37% of the market. When they fall, everything falls. Watch their stock prices daily. Warning sign 3, credit spreads, high-yield bonds, junk bonds. Right now, they are paying 2.86% more than Treasury bonds. That is the spread. If spreads hit 4%, caution. Investors are worried about defaults. If spreads hit 6%, fear. Defaults are rising. Companies cannot borrow. If spreads hit 8% or higher, credit crisis. The market is freezing. Nobody can get a loan. Recession is guaranteed. Watch credit spreads weekly. Warning sign 4, unemployment. Right now, 4.4%. If it hits 5%, the economy is weakening. Recession risk rising. If it hits 6%, recession is here. If it hits 7% or higher, deep recession. Maybe depression. The Fed will panic. They will cut rates to 0, but it will be too late. Watch unemployment monthly. Warning sign 5. The Fed. Emergency meetings. Statements. If the Fed calls an emergency meeting outside of their normal schedule, that is a red alert. It means something broke, a bank failed, a crisis hit. They are scrambling. If you see an emergency Fed meeting announced, sell. Immediately. Do not wait. History shows that emergency Fed meetings happen right before crashes. Not after. Before. They see it coming. And they are trying to get ahead of it, but they cannot. Watch for Fed emergency announcements daily. If you see 3 of those 5 warning signs flash red, reduce your equity exposure. Maybe go from 70% stocks to 50% stocks. Raise some cash. If you see all 5 flash red at the same time, go defensive. 30% stocks, 70% cash and bonds. or even all cash, because the crash is here, and you do not want to be the last one out. Because here is what this means for you, not some abstract investor, you, your 401k, your IRA, your retirement savings. Let me make this real. If you have $500,000 saved for retirement and scenario 2 happens, a 30% drop, you lose $150,000. Your $500,000 becomes $350,000. If you are 65 years old and planning to retire next year, you cannot. You need that money to last 30 years. You cannot afford to lose 30%. You have to keep working 5 more years, maybe 10. Your retirement is delayed. Your plans are destroyed. If you are 55, 10 years from retirement, you can recover, but it will take time. 2 to 3 years just to get back to where you were. And those are years you cannot get back. If you are 40, 25 years from retirement, you will recover. The market always comes back. But watching your savings drop 30% is painful, even if you know it will come back eventually. And it is not just your retirement account, your house. If we go into a deep recession, real estate prices fall. In 2008, home prices dropped 40%. It took 7 years to recover. If you bought your house in 2021 at the peak, you might be underwater. You owe more than the house is worth. You are trapped. You cannot sell without taking a loss. And if you lose your job and cannot make the mortgage payment, foreclosure, your job, if unemployment hits 7%, 1 in 14 Americans is out of work. Maybe you, maybe your spouse. Can you survive 6 months without income? Do you have an emergency fund? Most Americans cannot cover a $1,000 emergency. If you lose your job in a recession, you are in serious trouble. Your small business. If you own a business, recessions are devastating. Sales drop. Customers stop spending. You lay off employees, cut costs, maybe close. 44% of small businesses failed during 2008. If 2026 is worse, more will fail. This is your life, your money, your future. And the warning signs are everywhere. The Shiller PE ratio at 40.38. The Magnificent 7 at 37% of the market. $500 billion in AI spending with no clear return. A midterm election year. The Fed trapped between inflation and recession. Commercial real estate collapsing. China imploding. Geopolitical chaos. Every single risk factor is flashing red. And most people have no idea. They are scrolling TikTok, watching Netflix, buying stuff on Amazon, assuming everything will be fine. Because it always has been, until it has not. Let me bring this all together. The Shiller Price-to-Earnings ratio is at 40.38, the second highest level in 155 years of recorded data. The only time it was higher was December 1999, right before the dot-com crash. And that crash destroyed $6 trillion and took 7 years to recover. The track record is perfect. 6 times in history, the Shiller PE went above 30 during a bull market. All 6 times, a major crash followed. Drops ranging from 20% to 89%. 100% success rate. Never been wrong. Not once. And right now, we are at 40.38, 135% above the historical average. The math says the market has to drop at least 33% just to reach a Shiller PE of 27. That is the minimum, the best case. If it falls further, to 20 or 15, like in 2008, we are looking at 40 to 50%. But the Shiller PE is not the only problem. 7 companies control 37% of the S&P 500. Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, Tesla, the Magnificent 7. They are spending $500 billion on AI this year. $500 billion. Alphabet alone is spending $175 to $185 billion. 60% more than analysts expected. And the returns? Nowhere. 95% of AI pilots fail. 40% of projects are canceled. The costs are exploding. The profits are not materializing. This is the dot-com bubble all over again. Spending billions on infrastructure with no clear path to profitability. And when investors realize it, the selling will be brutal. And then there is the midterm election, November 4th, 2026. 70% of midterm elections result in corrections. The average intra-year drop is 18%. And this is not a normal midterm. Trump's tariffs are at Great Depression levels. The Fed is trapped. Inflation is sticky. Unemployment is rising. The economy is slowing. The uncertainty is off the charts. And uncertainty kills markets every single time. Jerome Powell warned us. September 2025. Quote, equity prices are fairly highly valued. The Fed does not say that unless they are terrified. December 2025. 3 FOMC members dissented. First time since 1988. They cannot agree on what to do because the economic data is impossible to interpret. Tariffs, inflation, recession risk, AI bubble, geopolitical chaos, too many variables, too much uncertainty. They are flying blind. And when the Fed is blind, crashes happen. So when does it happen? Most likely timeline. Second quarter of 2026, April to June. First cracks appear. Earnings disappoint. Market drops 10%. Third quarter, July to September. Midterm uncertainty peaks. Recession fears spread. Another 15% drop. Fourth quarter, October to December. Recession confirmed. Unemployment spikes. Final drop of 5 to 10%. Total, 30 to 35% from peak. S&P 500 from 6,900 to 4,500, maybe 4,600. The crash bottoms in late 2026 or early 2027. Recovery takes 2 to 3 years. By 2028 or 2029, you're back to break even. 6 years of pain. If you were planning to retire in 2026, you are working until 2031 or longer. The worst part? The Fed cannot save you this time. In 2008, they had 525 basis points to cut. In 2026, they have 150. In 2008, QE was fresh and powerful. In 2026, it is exhausted. In 2008, the government could afford a $700 billion bailout. In 2026, the government is $38.3 trillion in debt. They cannot afford anything. You are on your own. 155 years of data. 6 times the Shiller P/E ratio went above 30. 6 crashes followed. 100% success rate. Never been wrong. And right now, February 2026, the Shiller P/E is 40.38, the second highest in history. The Magnificent Seven are 37% of the market, spending $500 billion on AI with no proven return. It is a midterm election year, 70% historical correction rate. The Fed is trapped, only 150 basis points of room to cut. Inflation is sticky. They cannot respond like 2008. The government is 38 trillion in debt. They cannot bail anyone out. Commercial real estate is collapsing. China is imploding. Geopolitical chaos is everywhere. Every single risk factor is red, all at once. This is not one problem. This is 5 problems, 10 problems, all converging, all hitting at the same time. And the only question is when. Jerome Powell warned us, the FOMC is divided. The data is impossible to interpret. The crash is coming. The math is clear. 33% minimum, 30 to 35% base case, 40 to 50% worst case. The timeline is clear. Second quarter, first cracks. Third quarter, panic spreads. Fourth quarter, bottom falls out. Early 2027, stabilization. 2028 to 2029, recovery. 2 to 3 years of pain, 6 years total to break even. And if you are near retirement, you are working 5 to 10 more years. This is not a prediction. This is math. This is history. This is data. 155 years of it. And it has never been wrong. The question is not if the market will crash. The question is, are you ready? Do you have cash? Do you have a plan? Have you reduced your exposure? Have you shifted to defensive sectors? Have you prepared your family? Because the crash is coming. The Shiller P/E ratio guarantees it. The only question is whether you will be one of the people who saw it coming and protected themselves, or one of the people who ignored the warnings and lost everything. History shows that most people ignore the warnings. They assume it will be different this time. They assume someone will save them. The Fed, the government, Congress. But nobody is coming. You are on your own. The data is clear. The math is clear. The timeline is clear. The crash is coming. Are you ready? If this video opened your eyes to what is really happening in the market, smash that like button right now. Subscribe and hit the notification bell so you do not miss the next video where I break down exactly which stocks to sell first and which defensive positions to buy. Drop a comment below. Tell me which scenario you think is most likely. Soft landing, hard landing, or full crash? I read every single comment. And if you want the full list of indicators I'm tracking daily, check the description. I've created a free spreadsheet you can download. Track the 5 warning signs yourself. Stay ahead of the crash. Thanks for watching. Stay safe, stay informed. And remember, the Shiller P/E ratio has never been wrong. Not once. In 155 years. Do not be the person who ignores it.